so you're not distracted by all of the details behind me. And can everyone see my screen okay?
Yes.
All right. Great. Okay, so we're going to keep moving forward with these non-qualified plan definitions and items. I will wait one more second since we were just a couple of seconds here before noon, in case we have anyone else join. Okay. So continuing under these non-qualified plans, you have your deferral election requirements. A plan must provide that elections to defer income earned in a year must be made before the end of the preceding taxable year. If an employee's performance-based compensation will be based on work performed over a period of 12 months or more, the deferral election must be made no later than 6 months before the end of the service period. The time and form of distributions must be specified at the time of deferral, either by the plan itself or by an election of the employee. When contributions are not subject to the distribution restrictions or deferral election requirements, the contributions are included in the employee's income. To determine the amount to be included in the employee's income, the IRS has provided the following guidance. The amount includable in gross income because of a planned failure and required to be reported by the employer equals the total amount deferred under the plan on December 31st of the current year, not subject to substantial risk. An employer may treat an amount as previously included in income if it was reported by the employer on a previous year's form. The amounts previously reported and included in income should not then be reported again. Amounts includable in gross income under 409A include only amounts deferred that are subject to that 409A. In calculating the amount deferred that is included in income, there are 3 steps. First, you're to determine the total amount deferred under the plan for the employee's taxable year and all preceding years. Then calculate the portion of the total amount deferred for the taxable year that is either subject to substantial risk or that has been included in income in a previous taxable year. Then subtract the amount determined in step 2 from the amount determined in step 1. The excess is the amount includable in income and subject to those additional taxes. The treatment of payments. The sum of all payments deferred under a plan during a taxable year would be added to the amounts deferred outstanding as the last day of the taxable year. Treatment of deemed losses. Because the total amount deferred is determined on the last day of the taxable year, losses that occur during the taxable year generally would be netted with any gains that occur during the same taxable year. Treatment of rights to deemed earnings on amounts deferred. The proposed regulations provide that earnings credited with respect to deferred compensation during a taxable year or were credited in the previous taxable years, and earnings with respect to deferred compensation paid during the taxable year must be included in determining the total amount deferred for that taxable year. Kind of talking in circles, but trust me, that is the way it works. The total amount deferred for a taxable year under a plan would refer to the total amount deferred as of the last day of the taxable year. Under that example, if a plan is amended during the service provider's taxable year to add provision that fails to meet the requirements of 409A, the total amount deferred as of the last day of the taxable year would be included in income. This would include all payments under the plan during the taxable year, including payments made before that amendment. The treatment of short-term deferrals. For purposes of calculating in calculating the total amount deferred for a taxable year, the right to a payment as of the last day of the taxable year may or may not be a short-term deferral, is not included in the total amount deferred. Calculating that total amount deferred. The present value method. Generally, the total amount deferred under a plan for a taxable year is the present value of the plan on the last day of an employee's taxable year of all amounts payable to the employee under the plan, plus amounts paid to the employee during that taxable year. Discounting the present value. The proposed regulations provide that the present value cannot be discounted for the probability that payments will not be made or would be reduced because of specific rules. Restrictions not taken into account in determining present value are restrictions on payments that will or may lapse with the passage of time are not taken into account in determining the present value. There are special rules for determining the present value, and those require the use of reasonable actuarial methods and assumptions and provide specific rules on the crediting of earnings for situations where the amount payable is pursuant to alternative times and so forth. During determining the portion of total amount deferred for a taxable year that is subject to substantial risk of forfeiture, in general, that is determined as of the last date of the employee's taxable year, typically 12/31. Determining the portion of the total amount deferred for a taxable year that has been previously included in income requires that the service provider actually and properly have included the amount in income in accordance with the Internal Revenue Code. This pop quiz we have now goes back to some information that we went over yesterday. In 2020, an eligible employee may make a catch-up contribution up to what amount beyond the deferral limit of a 401k plan? Good job, B. When a 401k plan allows catch-up contributions, eligible employees and employees that are employees age 50 or older at the end of the year may make catch-up contributions up to $6,500 in 2020. Treatment of failures continuing during more than one taxable year. This rule generally would prohibit a service provider from selecting among several previous taxable years for the most favorable year in which to include income. However, if an amount was actually and properly included in income under 409A in a previous year, the amount would be treated as an amount previously included in income for purposes of all subsequent years. Premium interest tax. If compensation is required to be included in gross income, then the income tax imposed is increased by an amount equal to the amount of interest determined under 409A, an additional income tax known as a premium interest tax. Again, some of these glossary terms are definitely ones you're going to want to know the definition of. Treatment of payment or losses of deferred amounts in taxable years after they've already been included in your income. The payments or any amount included in gross income under 409A is not required to be included in gross income under any other provision of the IRC. Forfeiture or losses, the application of 409A may require inclusion in income of amounts the employee ultimately never receives. The effective date, generally applicable for taxable years beginning on or after the issuance of final regulations. Payments not subject to reporting. The regulations and notices include several types of payments that are not subject to reporting on Form W-2. Separation, severance pay arrangements upon involuntary separation from service are exempt from the 409 income inclusion requirements. Reimbursement arrangements related to a termination of service are not covered by 409A to the extent that the arrangement covers only expenses incurred and reimbursed before the end of the second calendar year following the calendar year in which the termination occurs. A non-discounted stock option that has no other feature for the deferral of compensation is generally not covered by 409A. Your additional taxes, if the requirements of 409A are not satisfied, then in addition to the value of the employee's account being included in income, interest will be imposed on compensation as if it had been included in income when it was first deferred, or when subject to a substantial risk of forfeiture, and the amount required will be included in income, is also subject to an additional tax of 20% that the employee pays when filing a personal income tax return. The reporting and withholding requirements. All amounts deferred under a non-qualified deferred compensation plan in a calendar year must be reported on Form W-2, Box 12 with code Y, whether or not included in income for that year. When the plan non-qualified deferred compensation fails to meet the 409A requirements, the income is included on Form W-2, Box 1 and Box 12 with code Z. In addition, the income is also subject to an additional tax of 20% that is not withheld by employers. Deferrals included in income are also wages subject to federal income tax withholding. Employer contributions and earnings are subject to Social Security, Medicare, and FUTA taxes. The date the services are performed that form the basis of the contribution, or when there is no substantial risk of forfeiture or vesting of the employee's interest in the funds. As a practical matter, these contributions will most likely never be subject to Social Security or FUTA tax under this special timing rule, since the executives earning the non-qualified deferred compensation will almost always have exceeded the wage base for those taxes before having the employer's contributions as wages. However, they will be subject to Medicare tax, including the additional Medicare assessed on wages above $200,000, since of course we all know that has no wage limit. Determining the amount deferred. A non-qualified deferred compensation plan is an account balance plan if, number one, the principal amounts are credited to an individual account for an employee, the income attributable to the principal amounts is credited or debited to the individual account, and the benefits payable to the employee are based solely on the balance credited to the individual account. The deferral equals the principal amount credited to the employee's account for the period. An amount deferred is taken into account when it is included in computing the amount of wages subject to Social Security, Medicare, and FUTA. For purposes of withholding and depositing Social Security, Medicare, and FUTA taxes, an amount deferred is treated as wages paid by the employer and received by the employee at the time it is taken into account. If the employer is unable to calculate the amount deferred for a year by December 31st, you have two alternative methods that can be used: the estimated method and the lag method. The estimated method is where an employer may treat a reasonably estimated amount as wages based on the date when the amount was taken into account, or the lag method is where an employer may calculate the amount deferred on any date up to 3 months after the date the amount was required to be taken into account. The reporting requirements. Employer contributions to an unfunded, unqualified plan that meets the requirements of IRC 409A are not included in income and are not recorded in Box 1 of taxable wages, but must be reported in Box 12 with code Y. One little tip for taking the test: make sure that you know some of the items in Box 12 that are the most common for retirement reporting. Pop quiz. Calculate the employee's net pay based on this information. Their hourly rate is $18 an hour. They worked 45 hours in week 1, 50 hours in week 2. They are non-exempt. They're head of household, requiring $2,000 as a dependent amount. Year-to-date wages thus far, $27,000. 401k contribution is 1% of their wages, and we're using the percentage method. The bracket is here. For time safety, I think I'm just going to skip forward and we'll go through the answers together so you can see what those answers would be. Hours in week 1, 45. Hours in week 2 is 50. Their hourly rate is 18. What does that come out to? Hourly wages of 95 times 18, 1,710. The overtime premium rate, the half time of that $18 an hour would be $9 per hour for those 15 hours. Comes to $135. We add those together and it comes up with a total gross wage of $1,845. Take away 1%, we have $1,826.55. So now we need to calculate the federal income tax on that $1,826.55. We know that it's biweekly, so that is 26 pay periods on 1B. 1C and 1D end up being 0 based on the employee situation that we just read about. Obviously then, when you do the math, you still come up with 1,826.55. And our adjusted wage amount ends up being 1,826.55. If we look at the row in which that 1,826.55 falls, we can see that the amount in column A would be 1,269. And the amount in column C of that same section of the table is $54.60. And the percentage is 12%. We do the math. Required in step 2D comes out to 557.55. You're going to multiply the amounts on 2D by the percentage on line 2C by that 12%, 66.90. Then we add lines 2B and 2E to get the tentative withholding amount of $121.50. We know that the employee requested $2,000 in employee or in dependent withholding amount. Divide that by our 26 pay periods, that comes up to $76.92. We subtract line 3B from 2F and it becomes $44.58. This employee did not request any additional withholding, so that amount would be 0 on 4A. So the total amount of federal withholding tax on this particular amount would be $44.58. Then we need to calculate what our Social Security and Medicare is to then retrieve what our net pay actually would be. Does anyone have any questions on this breakdown? I know I went through it kind of fast. Great, so guess what? This rounds out our section on retirement plans. Aren't you thrilled? Now we're going to jump into cafeteria plans. The term cafeteria plan, flexible benefit plans, or flex plans is used interchangeably. A cafeteria plan is which all participants are employees who choose from a minimum of 2 or more benefits that consist of cash and qualified benefits. When specific criteria are met, the qualified benefit is not included in gross income. Flexible spending account, or FSA, is often included in the cafeteria plan. Such accounts allow employees to pay for certain medical and or dependent care assistance expenses with pre-tax dollars. Flexible benefit program is often included in cafeteria plans. It gives employees the ability to choose benefits based on their individual needs. The choice is made between taxable and non-taxable qualified benefits. Your premium-only plans are used by employers who require employees to contribute towards benefits, usually health insurance. A POP generally does not offer a menu of benefits to choose from. It merely allows employees to pay for their share of the benefit costs on a pre-tax basis through salary reduction in the amount of the required contributions. That is permissible under a Section 125 plan. This is going to be a really helpful table to continue to study before your exam. Plus, it's helpful to know as you are processing payroll for your employers. Which types of cafeteria plans are included in a 125 cafeteria plan and which are not. Those that are not discounted at a pre-tax basis. Only the items included in the left-hand side of the table would be allowed to be pre-tax deductions. Your Section 125 plan document must contain the following: a description of the benefits available under the plan, including the benefit period of coverage, the plan's rules for becoming eligible to participate, procedures governing participants' elections under the plan, the manner in which contributions are made, such as salary reduction or non-elective employer contributions, the maximum amount of employer contributions, including salary reductions available to any participant, and a definition of the plan year. Plan documents and the election revocation of cafeteria plan must have a written document laying out the particulars of the plan, and it must be intended to be a permanent plan. Your deferred compensation is generally prohibited in cafeteria plans. A cafeteria plan violates this rule if it allows employees to either carry over unused contributions of benefits from one year to another, or use contributions from one plan year to purchase benefits the employer will provide in a later plan year. There is, of course, because the government's involved, there is a special rule when it's referred to purchasing paid time off. While a cafeteria plan may offer employees the option of purchasing additional paid time off with pre-tax dollars, the leave becomes taxable, meaning it's allowed to take place, but it becomes taxable when it's taken and is subject to several restrictions related to the ban on deferred compensation. More exceptions for deferred compensation being included in cafeteria plans. For cash or deferred arrangements under IRC 401k, which allow an employee to contribute part of his or her salary to a pension or profit sharing plan on a pre-tax basis, contributions to HSA, which allow contributions to be carried forward into the next year, carryover of up to $500 in a medical flex spending account or FSA from one plan year to the next plan year, and flexible spending accounts which are allowed a grace period of 2.5 months at the end of the plan year for participants to incur eligible expenses. Cafeteria plans and other flexible benefit plans are generally funded by the following mechanisms: flex dollars or flex credits, salary reduction, or after-tax employee contributions. The tax treatment of cafeteria plans. At the top, you'll notice the type of contribution, whether or not there's federal withholding, Social Security tax, Medicare tax, and FUTA tax. Definitely helpful to know what those items are. In our example, employee Richard earned $700 per week in 2021. Claims single, does not complete steps 2 through 4 on his 2021 W-4. He contributes $30 per week to his employer's cafeteria plan for medical and dental insurance. Using worksheet 1 from Richard's federal income tax withholding is $47.62. The Social Security rate is 6.2 and Medicare is 1.45 and the state rate is 5%, assuming the state treats the pre-tax contribution the same as the IRC. If Richard's contribution is pre-tax, his net pay would be figured like this. There's his regular wages, there's the medical and dental, and now we have his taxable wages, his taxable gross. Here's your federal income tax withholding, Social Security tax, Medicare tax, state withholding, and then bottom line net pay. If Richard's contribution is after tax, it would look a little different. It would look like this. His regular taxable wages would then be the full $700. Federal income tax would be $51.21 instead of the $47.62. Your Medicare and Social Security as follows. State income tax withholding, again, at $35. Medical and dental would come out just before that net pay. It's all in placement. Pop quiz. Which of the following statements is true regarding a Section 125 plan? Nice job. Yes, employer contributions taken as cash represent taxable compensation. Tax treatment and reporting requirements. Generally, pre-tax contributions to a cafeteria plan need not be reported by an employer on its quarterly 941 or on the employee's Form W-2 as taxable wages. Taxable contributions and benefits are reported as they would be if they were provided outside of the cafeteria plan. Permitted changes to a cafeteria plan. Most everyone is familiar with these. There has to be the ability to change during a marriage, number of dependents, employment status, all of those things, birth, death, adoption. I'll let you all read your examples yourselves. There are some, of course, special exceptions. The regulations include several exceptions to the change in status requirements to comply with mandates and other laws governing the availability of health insurance coverage, like COBRA, medical support orders that you receive with child support, etc. Participation requirement and non-discrimination testing. For highly compensated individuals, your corporate officers, shareholders, spouse or dependent of any of the above, key employees or corporate officers whose annual compensation is greater than 185 for 2021, or they're 5% or 1% owners with high income. There are three main non-discrimination tests that cafeteria plans must satisfy to qualify for preferential tax treatment. One is the eligibility test. Two, the contributions and benefits test, where each participant must have equal opportunity to select non-taxable qualified benefits. And the concentration test is qualified non-taxable benefits provided to key employees do not exceed 25% of benefits provided to all employees. So before anything happens, those key and highly compensated people must be identified so that then all those non-discrimination tests can happen for cafeteria plans and for deferred compensation plans. FSA, those give employees the opportunity to pay for certain covered healthcare and dependent care expenses with pre-tax dollars. The coverage requirements are specified expenses incurred may be reimbursed up to certain maximums and subject to reasonable conditions. It's less than 500% of the premium is allowed as a maximum reimbursement amount. The maximum salary deferral is limited to $2,750 each year. Pay close attention to the list of the following rules. Elections cover a full plan year. There's no deferred compensation, which means use it or lose it. Some plans have a grace period, which that grace period is 2.5 months after the plan year, where someone can then use their balance. And some plans offer a $500 carryover but they cannot have both the carryover and the grace period. Here's your pop quiz. An employee has elected to have $200 per month contributed to their FSA. At the end of the plan year's grace period, $100 remains in the account. What happens? Where does that $100 go? Great, yes, everybody got that right. Being the use it or lose it, the employer can use the amount to offset any administrative expenses in connection with the program. Uniform coverage throughout the coverage period under your FSA rules. The total of the employee's payments for the plan year must be available at all times during the plan year. There are special rules for dependent care assistance under that FSA. They are not subject to the uniform coverage rule. Employees can be reimbursed up to $5,000 of dependent care expenses each year, but only up to the amount they have contributed in premiums. Married couples can only contribute a total of $5,000. Eligible expenses include non-medical expenses that allow an employee to keep working and provide for a dependent's protection and well-being, not just children. Generally, a healthcare FSA must provide coverage for a period of at least 12 months with limited exceptions. You can read that there are some prohibited requirements and claim substantiation. Typically, you would have to provide a receipt or invoice copy of some sort to get that reimbursement. Reimbursements can be made only for medical expenses actually incurred during the period of coverage, including a grace period if one is written into the plan. Medical expenses are incurred when the medical care is provided, not when the employee is billed for the care. Another pop quiz. An employee uses a cafeteria plan benefits of $350 per month to pay for chosen benefits. That $350 represents what? Great job. Yes, A. Very good. Non-taxable compensation if not chosen as a cash benefit. So now we're going to switch gears again, and we're going to talk about tax deposits, the timing of them in the look-back period. You definitely want to know what that look-back period is, how it is determined, and how a depositor is classified. Withheld federal income, Social Security, and Medicare taxes, as well as the employer's share of Social Security, Medicare, and FUTA taxes generally must deposit the tax. You must deposit the taxes using the EFTPS system, or in very limited situations with a check and tax return. Another tip, you do want to know what EFTPS stands for and what it is used for. Monthly or semi-weekly is a depositor classification. The determination is based on the amount of an employer's total liability during a look-back period, which is 12-month period from July 1st of the second previous year through June 30th of the previous year. You need to know what that look-back period is. Tax deposit frequency. Your semi-weekly depositors, if the pay date is on Saturday, Sunday, Monday, and Tuesday, the deposit is due the next Friday. If the payday is Wednesday, Thursday, and Friday, deposit is due the next Wednesday. Definitely very important to know these frequencies. We have several slides that give you the examples that you can go through and test your knowledge. The shortfall or accuracy of deposits rule. The IRS allows a safe harbor shortfall so that employers are not penalized for depositing a small amount less than the entire amount of their deposit obligation. Any deposit shortfall doesn't exceed the greater of $100 or 2% of the amount of taxes otherwise required to be deposited. The deposit shortfall is paid or deposited by the shortfall makeup date. Monthly is with the next quarterly return, or semi-weekly, first Wednesday or Friday after the 15th of the following month. So it's important to know that anything outside of that particular time frame, you would receive a penalty. Agricultural employers and railroad retirement taxes. Annual employment returns form 943 rather than the quarterly 941 is what you would file. Their look-back period is the second calendar year preceding the year for which the depositor status is determined. Manual and off-cycle checks. An employer that pays employees between regular paydays incurs a deposit liability when the constructive payment and receipt has occurred. So when that money has constructively changed hands and been given to the employee. Calculate your federal deposits. The total liability consists of the following when it comes to paying in those federal income tax and federal taxes. The total tax liability consists of federal income tax withheld from the employee's wages, Social Security tax withheld from the employee's wages, Medicare tax withheld from the employee's wages, plus the employer's share of both the Social Security and Medicare tax. You can see how it's broken down there. Again, we suggest that you learn and know what EFTPS is and what it stands for. The Internal Revenue Code requires federal depository taxes not be paid with a tax return, but be deposited by electronic funds transfer, EFT, except under certain conditions when filing 940, 941, 943, blah, 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 paying by check. Your EFTPS Direct is an ACH debit entry. The EFTPS, after receiving instructions from the employer, instructs an employer's financial institution to withdraw the funds from the employer's account for that federal tax deposit. EFTPS through a financial institution is an ACH credit entry. The taxpayer instructs the financial institution to originate a federal tax deposit through the ACH system to the appropriate Treasury account. Your Federal Tax Collection Service, or FTCS, allowing tax deposits to be initiated and settled on the same day. Any FedWire participating financial institution can make same-day wire tax payments. Wires must be received by FTCS by 5 p.m. Eastern Time on the due date to be considered timely by the IRS. Your federal tax forms, these are definitely things you want to pay attention to. Please be familiar with all the types of forms. I know that I had questions even about what is an SS8. So definitely make sure that you know what the form is, what it is used for, and what type of information would then go on it. And of course, this continues because there are a lot of tax forms. Okay, now we're going to go through a very complex calculation. This particular employee has Section 125 cafeteria benefits. They have group term life. They have a 401k. They're receiving a bonus that's being calculated separately from their pay. This employee is single with 4 allowances, which is a little bit unique since they should have given us a 2020 example, but that's okay. So I'm going to walk through every single step on this worksheet because it's complex. We're going to use Worksheet 1 from publication 15T. The employee claims single with 4 allowances, has federal wages of $3,521.67. The employee's year-to-date supplemental wages are less than $1 million. The federal income tax compensation is still $3,521.67, which is their salary divided by 24, less 401k, less Section 125, which means the full $3,916.67 minus 235 minus 160. Then we're going to add the bonus at the optional flat rate to calculate the federal income tax withheld of $1,050 at 22%, $231. Step 2, we're going to take that 3,512.67 times 24. We're going to check the appropriate percentage table at the top. The adjusted wages are over 43.95, but certainly not over 89.325. Step 4, which is that 67,320 minus 43,925. Your excess amount is then 23,395.08. $4,617.50 plus that 22% times 23,395.08. You can see that math there. That means it comes out to a federal withholding amount of $637.85. So now we're going to try it on a different one. And we will fill in this particular worksheet together. So the employee has $82,000 in annual salary. The employee is married, filing jointly. Step 2 checkbox has been checked. $2,000 in step 3 and $125 in step 4C. The employee is exempt, paid semi-monthly. The employee is receiving an $850 bonus as an award on this pay period only. We need to make sure that we're noting whether or not the 401k comes off from this bonus. 401k contribution, 11% on all regular wages for each pay period. The employee has paid $4,885.79 to date. Their Section 125 cafeteria plan deductions are $140. They have group term life coverage in excess of $50,000, so an additional $20 is included in income each pay period. And their year-to-date supplemental wages is $15,000. Okay, so let's take this apart. We know that those year-to-date supplemental wages are $15,000, so the $850 bonus would still be calculated at 22% because they're not over $1 million. The 401k contribution is on regular wages. Therefore, they're not taking the 11% out of for a contribution under that bonus. So let's see. We want to break this down to get a per pay salary, which is $82,000 divided by 24. We get $3,416.67. Your 401k contribution of 11% is $375.84. The employee had $140 in cafeteria plan, Section 125, but we have to add back in that group term life. So the amount of income that is subject to federal income tax withholding is $2,920.83. So we have $2,920.83 in 1A. 1B, we know that there's 24 pay periods. The employee did not indicate anything in 1C or 1D, so we add those together and it still becomes $2,920.83. The total adjusted wage amount stays at $2,920.83. So if we find the row on the table, we have it is greater than 2,211, but not greater than 4,122. So that's the row that we're going to use. We're going to put in 2,211 in 2A. Now 2B, we need the column C of that row, which is $41. Oh, excuse me, $194.26. Now we're going to enter the percentage in column D of that row, which is 22%. Subtract line 2A from line 1H. And we get $709.83. Multiply the amount on line 2D by the percentage in 2C. So we take 709.83 times 22% and get 156.17. Add lines 2B, 194.26, and 2E, 156.17, and we get 350.96. Now we're going to enter the amount that the employee indicated from step 3, which was 2,000. Divide that by your 24 pay periods. And we're going to subtract line 3B from 2F, so 350.96 minus 883.34 becomes 267.62. Now we're going to enter that $125 that the employee wanted additional and add 267.62 plus 125. Your federal withholding tax becomes $392.62. And there's our federal withholding tax. Step 1 is done. We have a bonus, but that bonus is being taxed at the supplemental rate of 22%. The bonus was $850. That becomes $187 of tax on that. Your total federal income tax on this particular employee's pay is $579.62. And I'm going to go back to the initial slide because, as you can see, we put on here that it did not ask for Social Security or Medicare. Let's just get to it. Based on the following information, calculate the employee's federal income tax withholding for this pay. So just keep in mind the way these questions are worded. You will think that you're looking for net pay, or you may be thinking that you need to come up with everything, and you may have in your multiple choice answers, you may have an item that you would come up to by pulling all of the numbers rather than reading, oh gosh, they only want federal income tax. They can also trick you by saying federal tax. They say federal tax, they're looking for everything, which would include FICA and Medicare. They say federal income tax withholding, it is just using, like we did here. To get to that. How did everybody do with these calculations? You're probably getting to be quite pros because of Melissa's fantastic training.
The second one made a lot of sense. I want to go back through that first one that we did, just because it looks a little different.
So tell me which one is the first one.
I think it was this one. Oh, go back. Yeah, this one.
Okay.
And I think it's just different because we didn't actually put the calculations on the line. So I want to go back through and actually put them on the line. So I see it.
Okay, great. I did not put them in through on the line. I just went by the slide. So I did on that last one, go through line by line.
You know, for me, it's helpful to go line by line. I don't know if that helps. Is anybody else?
Well, let's see. First of all, we need to make sure we know what all of the requirements are. Based on the following information, calculate the employee's federal income tax withholding for this pay period. So again, we're only looking for that federal income tax. Keep in mind, it is saying that 6% on regular wages, not necessarily on those 401k wages. We have to add in the group term life of $16 and a cafeteria plan of $160. So yes.
Thanks for taking us through everything this week, Rebecca.
No problem. We can actually work through this one if you want, or we can do this when you're studying, whatever. And if anyone else is interested in working through this one, we can.
Yeah, let's go ahead and do it.
Okay, great. So I have to refresh my memory. What did they say? Paid semi-monthly. Okay, that's what I was needing. So they're paid 391,667, and I know that's on the screen, but I'm also doing the math, so bear with me. And that 401k deduction is 6%, so 6% of that is $234.40. They have a cafeteria plan of $160. I can see they rounded up to that 235. So initially, and then we need to add back in the $16 for the group term life. So they should have taxable wages for the pay period of $3,538.27. That is what you would put on 1A. The number of allowances that the employee claimed on their most recent W-4 is single with 4 allowances. So we're going to enter the amount or multiply the amount in 1B, which is 4, by the amount in table 6 for your pay frequency. Since they are semi-monthly, we're going to multiply 4 times 179 is $716. That's what you would put in 1B. Excuse me, 1C. Then you're going to subtract that 716 minus the 353827 makes adjusted taxable wage of 282227. Now we're going to figure that tentative withholding amount. So 2822 is going to be a very top line, 0 to 3,800. Look. Oh, and I did not do that. You're right. So we want to take 282227 times 24. 67, 734.48. Which is going to be on that 22% line. So we're going to add 43,925. Into A. To B would be column C of that row of 4,617.50. And 2C would be the 22%. We're going to subtract 2A from line 1D. Use this to get some of our numbers back up here.
So you subtract the 43,925 from the annualized
734.48. So now we know that our excess amount is 23,395.08. Then we're going to multiply that amount by the percentage line on 2C. So we're going to times that, which is 22% times 23,395.08 is 46,1750. That makes our actual tentative withholding amount be 406.85. Then we're going to add that bonus of 1,050 times 22%. Add that to our 406.85, and we get a total withholding amount, federal income tax withholding of 637.85. It'll be interesting to see how many calculation items you have on your exams to see if they alter either the number of them or if they alter the amount of time that you have, because they still want to fill that entire 4-hour gap of time And I feel like these calculations take way more time than they used to. So. Well, this concludes our week of deferred compensation, cafeteria plans, and then we got started on some federal tax deposit rules. Is everybody thrilled?
Thanks for going through that, Rebecca.
No problem. No problem. I hope everyone has a fantastic weekend.
You too.
Thank you, bunch.
Bye.